Test, Optimize, Scale. Very excited to have Karl Sjogren here, author of the Fairshare Model, Remaining Capitalism at the DNA Level. And this is a performance-based capital structure for venture stage, initial public offerings. Karl, welcome to the show.
I'm thrilled to be here.
Excited to have you on, have heard a lot about you from the team and enjoyed our discussions thus far. It was highlighted for us. We have to get Karl on, knowing everything about your background. Would love to get a better introduction for the audience here. What's your story? What's been your professional career to date?
Well, most recently, I'm the author of the book, as you mentioned, the Fairshare Model, and that's what it looks like. You can see the Fairshare Model, and as you said, it's about a performance-based capital structure for venture stage public offerings. And I say it's reimagining capitalism at the DNA level because it looks at how to balance and align the interests of investors and employees. And the former chairman of Silicon Valley Bank called it an important work. But DNA image is part and partial of it. Broadly, I've had a 35-year career in the San Francisco Bay Area doing CFO work for startups and turnarounds. Before that, had about a decade or so experience in the Midwest with dominant manufacturers. Grew up in the Detroit area.
Detroit, very nice. Very nice. And so what got you thinking about the Fairshare model? Or maybe we should just start with the model itself. Could you tell us more about it, the structure, and how we should perceive it throughout this conversation?
Yeah. So the Fairshare model is an idea for how to structure a initial public offering, the capital structure, for a venture stage company. A venture stage company is one that loosely you can just refer to as a startup. But basically, you know, they're companies that rely on their survival on raising fresh capital because they don't generate enough cash themselves. So and it's not uncommon for these types of companies to raise venture capital in an IPO. If you go back several decades, virtually all biotech companies are venture stage companies when they have a public offering, and many tech companies. So the idea is they're very hard to value reliably. And so the approach that the Fairshare model takes is to have two classes of stock. Both vote, one trades, one does not. Investors get the tradable stock, so that's the IPO investors and the pre-IPO investors. Employees, and that includes founders, get it as well, the tradable stock, for value generated as of the IPO date. But for future performance, where most of the enterprise value is, the employees get a voting stock that cannot trade. It converts into the tradable stock based on milestones they describe in their prospectus or offering document, or subsequently, both classes of stock agree to after the IPO. So the basic idea, the fundamental difference is that in a conventional capital structure, at the time of the equity investment, a valuation is set on future performance. And my thesis is it's hard to do that reliably. With the Fairshare model, at the time of the equity investment, no value is placed on future performance whatsoever. What is established is how to reward future performance.
So this is very important, highly relevant to our audience. We work with a lot of startup to mid-stage brands, as well as groups in the venture community, VCs, angel investors, all different types of funds and organizations locally and international, all sides of the table. if you will, equity crowdfunding portals and service providers alike. And we'll get asked all the time, can you work on the marketing section of our business plan? Can you work on our revenue model? We need to show how we're going to acquire users, how we're going to acquire various types of customers to either produce enough revenue or increase our valuation at different stages of the timeline for our growth model. A lot of the times those are platforms. I think a lot of people think of movies like The Social Network, where it's Facebook, and they're talking about an average revenue per user. That's how I was first introduced to these models of social games. But basically what each user is worth, whether that's through media dollars, whether that's a perceived value, and looking to calculate the valuation from there. Much different than looking at historical type of structures to assess all of the assets, maybe look at comparables and put a number on it in that fashion. But mentioning all this because we get asked all the time, what should our valuation be? And the Fairshare model being a system to get there that, to play on the words, is fair for all sides.
Yeah, basically what you've discussed, sir, you described, is how to manage expectations, how to create them, how to form them in a defendable way. And so all that energy is going into trying to figure out how to make someone think differently about the future, right? What the revenue model is, what the channel is, how durable the technology is. All of this is very hard to predict. The drivers of valuation is analytics, emotion, and terms, deal terms. Analytics is that body that you were describing, the assumptions that are in a revenue model. It could be some aspect of marketing, but that body of work. I'll come back to that in a moment. Emotion is, as you well know in marketing sphere, is what's capturing attention, what's holding it, and creating excitement. And that happens in the private capital market as well as in the retail, goods and every market. That's an important area. Deal terms is something that I really get into in the book because it not everybody uses it. It's used exclusively or all the time in the private capital market by sophisticated investors. So virtually every VC fund, private equity fund, some angels use it, but for the most part, it's for the professional. It's not used at all in public offerings. And that's what I'm really exploring with the Fairshare model. So let's go back to that first variable, analytics. There's two big problems with it. The first one is no one's very good at predicting the future. So, in computer science, there's an old saying, garbage in, garbage out. It sort of applies to this. And it's not because it's bad analytics. It could be great. But, the half-life of corporations has been shrinking dramatically in the last several decades. What in essence you're saying in your analysis is, okay, if let's say I did 5 years and starting in year 6, I have a terminal value. What that means is that I've picked a number for year 6 that in perpetuity, this company that is going to be generating in terms of profits. Now, go back to the initial idea of the half-life of companies shrinking dramatically, even for established companies, and you just see how the foundation of that analytical exercise is built on sand.
Interesting. I haven't seen those type of processes put into place often. You know, a lot of the campaigns we work on, as mentioned, are through equity crowdfunding. It's designed to democratize the private equity opportunities and even remove conversations around some of the terms. So the analytics, the emotions, absolutely present. The terms, there can be bonuses for the first percentages of the investments of what's available. But I know that removes a lot of it from the equation. What are your thoughts towards that? What are your thoughts towards equity crowdfunding? I believe you were one of the early equity crowdfunding pioneers, correct?
Yeah. Oh, so I have to tell you the backstory on the Fairshare model, how it came to be, and then I'll get back to that.
Yes, please.
So back in '97, I started a company with another guy, and we called it Fairshare. And the idea was to make it easier for companies with small public offerings to find investors without having to necessarily hire a broker-dealer. So the approach we took was to organize the buyers, using online to create an online community of people who were interested in potentially investing in small IPOs. So our plan was to use education about deal structures and valuation to attract people, to give them the ability to interact in chat rooms, sort of like a Facebook before there was a Facebook. And then once we got to a critical mass where we could have enough investors that potentially could take down an offering, we were going to tell companies, if you have a legal offering, if you pass due diligence, if you use our deal structure, and you allow our members to invest as little as $100, we'll give you free access. No commission. We're not going to handle anybody's cash, anybody's stock. It was a buyer's collective, if you will, and nobody was committed to an investment. So that was sort of the vision. So that's what created the idea. And when you think about it, crowdfunding was a pretty good term to describe what we were attempting to do. But that term wasn't coined for another 10 years or so.
Right. Really didn't pick up till about 2008 around the financial crash. We're seeing similar types of effect here in equity crowdfunding in 2020. So they're trying to draw the analogies around it and businesses looking for capital in new places, which again, I think is why this episode is so timely, because I know a big part of what you try to emphasize is capitalism working for more people.
Yeah.
So the investors as a focal point, as a tier one, as part of your model, but the entrepreneurs definitely being the other side of that conversation and being able to structure things accordingly for everyone to have a win.
Yeah. So the idea is to think of this as the game of roulette, you know, and the odds that you're going to, from an investor's perspective, you're going to, you only win if you put your chip on a winning number. And the odds are what they are. Fairshare model doesn't change that. What it does do, though, is encourage the cost of a chip to come down. And the reason is it does that is it puts no value at all on future performance. That's where like 80% of a company's value might come from. It shifts the energy from the expectations game to saying, all right, here are the things that we're going to do, and this is how we're going to reward ourselves. And so the bargain is that a company, when it has an IPO using the Fairshare model, will be in a position to offer investors a deal to attract, beyond the attraction of oh, this is this particular market or this technology, this is the team, all of things that could be triggered by fueled by emotion to make investors have an interest. You now have another factor. It's a deal. It's a crazy Eddie type deal. Our valuations are insane. So let me give you an example. Let's say I'm a CEO of a private company and I've raised $5 million over the last year and a half or so. And now and maybe it was a combination of the VC and angels, doesn't matter. But now I want to raise $20 million. If I were to do that, let's also assume that comparable companies are thought to be valued at 100 million. So you would expect that with the conventional capital structure, I would go out with a pre-money valuation of 100 million. I'd raise the 20 in the IPO, and immediately after the IPO closes, I'd have a post-money valuation of 120 million, right? And then because it's public, the secondary market will do whatever it's going to do. Now, with the Fairshare model, I would have incentive to do a different type of pre-money valuation. I might say, if a measure of performance is a rise in the market value of the company, of the public stock, I might go out with a pre-money valuation of 10 million. I'd still raise 20 million in my IPO. Immediately after the IPO closes, my post-money valuation would be the 10 plus the 20, so 30 million. And then why would I do that? That's insane. The reason is, if one of my performance criteria is a rise in the market value of the company, I have incentive to price it really low to begin with. Now, how would my investors feel about that? Both the public and the pre-IPO ones? As my employee stock is beginning to convert into the tradable stock, they're getting diluted. Doesn't sound very good, but I say they don't care, because the value of their position is going up. The bet I'm making as that CEO is that investors in the secondary market are going to say, this company is underpriced. It ought to be trading up. So as that happens, if it happens, that would trigger the dilution. It could be very well be that within a few weeks, a month or whatever, if they're in parity, that the insiders have the same type of position that they would have had with a conventional offering. But what's different is that the IPO investors, first off, the company was able to attract investors quicker because it was a deal. It closed faster. But the investors made money because it was underpriced. It's almost like thinking about the price of a big screen TV on Black Friday. It may be typically worth $2,000, but if you have it on sale for $500 and then you go out and sell it for that kind of idea. Yeah.
Positioning for that secondary market is something that isn't as involved in the equity crowdfunding conversations today. I know some of the portals are out to create secondary markets within their platforms themselves. Not all of the groups actually have a direct plan to go public. So it's definitely very interesting to talk about. I like the long-term strategy and how it is focused on that later result versus a quick response out of the gate.
Yeah, let me mention just a few things here, Jason. I punted down on your crowdfunding thing. Crowdfunding to me is primarily the innovation in how stocks are sold. It's not an innovation in how it's structured. So the Fairshare model could be sold, an IPO using the Fairshare model could be sold using crowdfunding channels, and it could be used to sell just to retail investors, which is what you tend to think of in crowdfunding. But it could be used by established brokers. It could be, a company could decide to sell all of, in this example, the 20 million. It could sell it all to accredited investors if it wanted. It's sort of like a Spotify IPO, if you will, because basically the shares are registered, and so you could still attract the capital in the private market in essence, and just say you're going to get registered shares and you can sell off. So it's the same concept there. You could also have a hybrid, and from a marketing perspective, this will be interesting for you. Let's say I'm a company that has a consumer product. I want to raise that. I'm still using the example of the $20 million IPO. Let's say I've identified investors who could take down the full 20, but I have a marketing objective in mind with my IPO. So I say, okay, I'm only going to ask you guys to invest 15, commit to 15 at the get-go, enough to close the offering. But for, say, a month, I want to allow retail investors to invest $100.
Mm-hmm.
The reason, this would be actually a pretty good thing for all involved, because it would help qualify the company to list on an exchange that counts the number of shareholders. It would create some secondary trading market, which is good for the accredited investors as well as the public investors. But for the company, normally what you would find happen is that a company would raise, say, the 20 million and then spend $5 million on a marketing program. They would use capital, equity capital, for an expense. By virtue, if a company allocated a portion of its equity offering the way I just described, it would be achieving a powerful marketing goal without any expense at all, merely by how they distributed their shares. So that adds another dimension to thinking about public offerings. Let me just mention one thing about the performance. I said a rise in the capital structure, or capital, the market value of the company could be a measure of performance. Other ones I hypothesize on is developmental goals. Could be the release of a product, getting through FDA testing of some kind. Could be strategic partners that you're bringing on. Could be financial, revenue and profits. It could be the eventual acquisition price, if there is one. But it could also include measures of social good, which kind of gets into this social capitalism movement, impact investing that we're seeing. That maybe the richer ways, more diverse ways to define performance. So it's really an open whiteboard. I say that I think the Fairshare model will be to capital structures what the Linux kernel is to computer operating system. In other words, open system.
Yes.
Lots of variation in how it's implemented.
And so, a lot of great information here. where do we go from here for the listeners and looking at, the test, optimize, scale format as an entrepreneur or a young investor looking at where to position? What can the audience test out? What doesn't work right out of the gate, and how do they optimize it from there? And what can ultimately be achieved, be scaled at that point?
Great question. I would say for everybody, it makes sense to learn a little bit more about how things work right now. Mm-hmm. And the book explores that in length. It's 400 pages, and I'd say that, when I was writing, my mental census to who the reader was somebody in their 20s or 30s, and they're trying to make sense of capital markets and entrepreneurship and venture capital. So it's very accessible, but just part of it, of the process of starting to think differently about something, you begin by getting a richer sense as to how it is now. Now, once the next thing, and this is more for the entrepreneurs and the service providers, to be thinking about, okay, how would a particular client or a particular company define performance? How to reward it? How to measure it? How to report on it? With a telescope, you put it up and it brings into sharper focus things that are distant, future performance. In a way, this is an exercise of flipping the telescope. You're trying to figure out what are my performance metrics going to be? How do I want to reward it? So that's going to take some thought. And the service provider community plays a big role in this, because it's going to involve people in law, accounting, tax, corporate governance, human motivation, advertising, because you have to basically market the idea. So it's a big thing, but it's a process. And so fundamentally, what the Fairshare model is trying to do is provoke a social movement. And I don't know if that first offering that comes out is going to be in a year or 7 years or something. And the how quickly other companies adopt it will be based on two things. One is relatively easy to figure out, but the other one could take some time. So the first one is, does it help a company raise capital? And I think it would. People like a deal. That's not controversial. The other thing that's going to be a profound effect of the Fairshare model will be how it affects the ability of a company to attract and motivate employees. So let you go back to this example of the company that had a $20 million IPO using the Fairshare model. And I'd say I'm the CEO and I want to hire you, Jason, and you have an offer in hand from Apple. So I would say, Jason, I'd like to hire you. I can offer you a salary, not as much as Apple. I can offer you benefits. They're not quite as nice as Apple's. I can offer you options on my tradable stock. And they have more upside than Apple's. But I can offer you something that Apple cannot. And that's an interest in my performance stock pool. That's what I call the voting stock that can't trade. And it only has value if we as a team are delivering these results. So that kind of, you know, in history, you remember the story of Sir Francis Drake and an English fleet battling the Spanish Armada, you know, big warships. The English won with small, more nimble strategies and ships. I think the same thing can happen in capitalism. You can have a more competitive economy, more competitive companies by doing a better job of balancing and aligning the interests of investors and employees. So that's sort of the big idea.
I like that. I like how you put it in the employee stock owner perspective as well too, as you talked about shares that trade, shares that don't, ones that become available during a public offering, really brings it all to light. And you know, again, really excited by what you're building here. If there is one recommendation that you want to leave audiences with, what would that be?
Just realize that it's possible to innovate in venture capital. Venture capital is all about, you know, recreating, demolishing, doing something different. You can do that in capital markets too. And I think there's a chapter in the book about income inequality and economic growth. And I was working on it a couple of years ago. And at the time I thought about what was the epic struggle of the 20th century was whether the commanding heights of the world's economies would be controlled by centralized planners or by market economies. I thought, gee, what if you were 1915 or something like that, to go on to the man or woman on the street and ask, hey, what do you think is the major challenge of the century? It's unlikely they would have said that. And heck, the Russian Revolution hadn't occurred yet. So, and you think about what's the principal struggle for the 21st century, I think it's going to probably have an environmental angle to it. Could be terrorist war type thing. But if we focus on economics, it's whether the benefits of capitalism can be more broadly and fairly realized. Mm. So the innovation in capital markets is where it begins. That's where the DNA is set for a corporation. And if you can get the incentives right, interesting and good things can happen.
I live by that. Innovation in capital markets, get the incentives right. Part of why we're such a whole fan of, you know, these micro funding processes and all types of new structures, as it's that age-old story, and going back to some of the discussions in the beginning of how do we raise capital on a group that we can't place a clear valuation on. So I think this is a strong, needed solution for all parties involved.
Service providers like yourself,
yes,
have a huge role to play here.
That's as we see it. Yes.
I'm talking the securities attorneys, the tax accountants, the audit people, marketers, the corporate governance, the HR people, the exchanges. So if just that idea, it's possible to start figuring out what best practices might be and how they might vary depending on the industry and the stage of development, and even the personalities involved, frankly. Mm-hmm. It could be a very interesting time in the next few decades.
Oh yeah, I think the way technology allows individuals to play more of a role in general will take down a lot of the structures that were put in place. You know, even looking at the Jobs Act, Title III, making unaccredited investors a seat at the table, all within one seat. But what that opens up is definitely going to shift the thinking over the next 5 to 10 years. That's what we're looking to position in. So again, everything that has occurred, and haven't even talked too far in depth about 2020, and some of the things we're seeing here, but highly relevant for the current marketplace today.
I'll leave you with a thought. One of the chapters in there deals with people who might feel that capital structures is a little too complex for them, and it is a complex topic. But I had a couple of analogies. I'll share two of them with you. One is simply that think of capital structures as art. And I describe how I experienced art in the museum. I'll have to stand back and look at it. I'll get close, look at the angle, look at the placards. And over time, I start to pick up things on new pieces that I hadn't seen before. I can start to stitch all of this together. Capital structure is no different. The other one's a little bit more provocative, and it's about sex and sexuality. So I say, think about where our society was in the 1950s regarding sex and sexuality, attitudes about it. Think about where we are now. You'd say, times are different, things are different. But physiology didn't change. It's just the way we think about it. And I say that where we are now in terms of how we think about capital structures and capitalism is the equivalent to where we were in the 1950s thinking about sex and sexuality. It's going to be different.
An evolving perspective in the decades to come.
That's
Absolutely.
all it takes. So I want I call upon in the book the example of a movie in the mid-70s called Network, and there was a principal character there who was a newscaster who urged his listener. He was upset about where news was going, and said, "I want you to go to the window, open it up, stick your head out, and yell, 'I'm mad as hell. I'm not going to take it anymore.'" It's the same idea.
I love it. And honored to have you on today. Truly a visionary on where this is all going in the years to come. So thank you for sharing all this with the audience. If anyone wants to find you online, what is the best channel to do so?
I'm LinkedIn. I have a website called FairshareModel.com. My email is Karl with a K at FairshareModel.com. I'd love to connect with people around the world because this is something that can take place in various formats. Bear in mind that Linux example. There's going to be variation. Variation based on the industry, stage of development, and the personality.
Absolutely. And that's great that you make that available for them to get in contact. I could think of questions for different groups we work with to be able to speak with you about how to structure, analytics, emotion terms to fit into the model on a stronger level. So definitely encourage the audience to get in touch with you there. And again, want to thank you for coming on today.
Thanks, Jason.
Good. All right.
Bye.
Thanks, everyone. Take care.